With all that's going on in the stock market and the recent drops we've seen and the coronavirus and what's going on in the oil markets, we wanted to sit down with Scott Garliss, our senior analyst and editor of Stansberry Newswire, to talk a little bit more about what the Federal Reserve is thinking about and what kinds of tools they have in their toolbox at a time like this. Scott, take us through kind of where they can go to help increase liquidity in the economy right now.
Sure. So right now, the Fed has the obvious tools. They can cut interest rates, which we recently saw an emergency rate cut of 50 basis points, and they can also expand the balance sheet. They would do that through purchasing mortgage-backed securities or more treasuries. But we recently had an idea thrown out there from Boston Fed President Eric Rosengren, where he's talking about expanding the types of securities the Fed could buy. So what that would mean is, some people have thrown out the idea of buying stocks. That seems a little far-fetched. It's possible. Okay. But the other thing there, what you'd really be looking at is the Fed possibly going into the corporate bond market and buying corporate bonds, obviously, and helping companies in terms of liquidity and being able to sell bonds so they can raise money. And the really big important theme here with everything that's going on in the credit markets is the Fed wants to make sure the credit markets function properly. Because if they don't, what happens is that can have ripple effects all over the economy.
They want to make sure people can borrow so that people can spend,
yes,
so they can power the economy, because 70% of the economy is consumer spending.
That's exactly right. So they need to make sure companies don't default, they stay afloat. That way people stay employed, they have money in their pocket, and they spend is exactly right.
We've seen some of this before. About 10 years ago, we had the financial crisis. Yeah. Is there anything that we learned or that the Federal Reserve learned from that period of time that could come and help us right now?
Well, I think yes, 100%. What they're doing is they're trying to be proactive and they're not waiting too long. And I think that's why they were quick to do this 50 basis point rate cut. And that's why they have people like Eric Rosengren talking about expanding the types of securities they could buy. Also, another thing that's been going on at the Fed is Jerome Powell has the staff looking at other potential things that the Fed could be doing to expand their toolkit. And that's a big deal because the last time this happened, we wound up with quantitative easing, which, as we all saw, that's what really brought us out of the financial crisis. And again, that's because it made the bond markets liquid, and it stopped them from turning into a situation where someone came in to sell something, but there weren't any buyers.
One of the things you've been writing about is that the Federal Reserve needs to be sort of on guard from what the hedge funds are doing, and that investors need to learn from what the hedge funds are doing and be prepared to do the same. So I think basically what's happening right now is you're seeing a lot of the really big, smart hedge funds have pulled out their financial crisis playbook. And so what they're doing is they've gone back and they said, okay, the last time something like this happened and there was a potential crisis in the credit markets, how did it play out? What were the things that really cratered? And so what they're doing is they're going and getting short things that cratered, like corporate bonds. And so by short, I mean they're selling these things in hopes of buying them lower later. And they're buying the names, defensive names like gold, that are probably going to rally because of fear. And what that does is, as that plays out, that makes other people more nervous as they see things like credit spreads start to widen. And when they see credit spreads widen, they worry that companies aren't going to be able to access loans the way they were prior, or they're going to have to pay a lot more, which is going to hurt their balance sheets. Now, bank CEOs are already weighing in on this. They're meeting with the president during this period of time. What are some things that would really help the banking sector?
I think some things that would help the banking sector is to know that the White House has their back, to know that the government has their back, to know that the Fed is going to make sure everything holds up. That would make, again, making corporate bond markets more liquid is what's really going to help the banking sector. And what you need to see is you want to see these yield spreads that have blown out in the BBB rated and the high yield markets start to come back a little bit. Banks need to be able to make money on loans. If they can't make money, they're not going to lend. And if they can't lend, companies aren't going to have access to funds. And then that starts to play out all over the cycle where people lose jobs, and that hurts the economy overall.
So what are some things that our subscribers at Stansberry should be thinking about, given all of this turmoil, given what the Fed could do, given that we might actually see new tools to help the economy grow?
I think people need to keep everything in perspective right now and not panic. panicking can be the worst thing that could happen. I think also this highlights why you want to have a diversified portfolio, why you want to be involved in, be invested in precious metals, things like gold and silver, and why you want to be invested in bonds.
Okay. Thank you.
Thank you.